Going on YouTube? Welcome to the Living Freed channel. My name is Tyler Freed, and in this video, I'm going to be showing you some of my favorite index funds. I've been promising to do this video for quite some time. I had a very busy home time this last time. I was watching my son every single day. I just did not have enough time to do this video, but I'm doing it now. And I was just busy hanging out with family and things like that, so I didn't get around, like I said, to doing this video, but I'm doing it now. I got the time to do it. I'm going to try to make it as quick as possible. There's going to be a lot of information that I'm covering in this video. There's going to be like 4 parts to it. The first thing is going to be the foundation you need to lay, or what the foundation I laid before I began to invest, and I believe everybody should lay before they begin to invest. The second thing, I'm going to be explaining why I like index funds as my vehicle or investment vehicle of choice. And then thirdly, I'm going to be showing you a few index funds that I like. Now, some of you at the end of this video may be saying, hey, you excluded, what about this index fund? What about that index fund? These are going to be funds that I like personally. And that's not to say that there's not other great index funds out there to meet whatever you're trying to accomplish or to meet your investing needs or whatever. These are just what I prefer to invest in. And and then fourthly, at the end of the video, I'm going to be pulling up an investment calculator and playing with some numbers to show you the power of compound growth, the power of saving and investing over a long period of time. I'm going to be getting into that and kind of explain what financial freedom is. Before I got into trucking, and this is what I talk about on my channel all the time, is I wanted to create financial freedom by the age of 35. And the financial freedom to me is the ability to live off of your portfolio, to create enough income from your investments to pay all your bills and pay for your lifestyle, pay for everything without needing to work for money, without needing to earn that money to pay those bills. That's my goal. That's been my goal ever since I started in trucking. And for those of you that are not in trucking watching this video, the same thing can apply to any career. What I'm talking about in this video, I'm just mentioning trucking. That's because what I do, and a lot of people that watch my channel are in trucking, and they can do exactly what I'm doing. I started 4.5 years ago in trucking, and now to begin with, I did have zero debt coming into trucking. I did have a 6-month emergency fund saved before I got into trucking. But I did not start investing in the stock market until I got into trucking, okay? And I was able to put away, I've been able to put away 50+% of my income since I got into trucking. And a part of that is because I had no debt and I did have that emergency fund laid to begin with. A lot of you that are watching this video are going to have to pay off debt and going to have to save up an emergency fund. That could take you a year, 2, 3 years, but it is worth it 100% so that you can do exactly what I'm going to be talking about in this video. But again, my goal was to create financial freedom by the age of 35 so that I could not quit working, but have options, have that freedom to work on things I really want to work on. And that's been my goal ever since I started, like I said. And I talk about this not to brag about having multiple 6 figures invested after 4.5 years. It's not to brag about that. It's to tell people, hey, it's possible to do that with trucking. It's possible to do that with an average everyday career. It is 100%. It just takes knowing a few things and discipline over time, and you can accomplish that. Anybody can accomplish what I'm talking about. So anyway, like I said, there's going to be 4 parts to this. Number 1, the foundation you need to lay before you begin to invest. And everything I'm talking about in this video is what I did. None of this is personalized financial advice. This is strictly for entertainment and educational purposes only, and just me, honestly, just sharing what I do and what I think could work for a lot of people. You don't have to do anything I'm talking about. You don't have to invest in anything I'm talking about. Maybe you just want to watch this video to get a different perspective that you've never heard before. So anyway, number 1, before I began to invest, the first thing I had to do was invest in myself. I knew I wanted to create financial freedom a couple years before I got into trucking, but I did not have the income to save and invest a large percentage of my income. I didn't have that income to reach financial freedom. Well, that's why I looked at the trucking industry as a way to create that income to where I can save 50-60% of my income and get to that financial freedom target at that early age like I wanted to do. But I first had to invest in myself. So, number one, invest in yourself. That is going to be the best return on investment you get, is by investing into a career, investing into a business, to where you can get your income up to a high level. What's a high level income to me? It's the ability to save and invest a large percentage of your income. At least, in my opinion, at least 25% of your income, you're able to consistently save it and invest it over time. That's number one, invest in yourself. Number two, get and stay out of debt. Pay off all consumer debt, student loans, credit cards, car payments, anything that's charging you interest and taking away from your income. Dave Ramsey says it all the time, and he's absolutely right. Your most powerful wealth building tool is your income. And if you're paying debt all the time, if you're constantly servicing debt, you're unable to save and invest and get ahead. You have very little margin in your life. You have very little possibilities to save and invest a large percentage of your income. So starting out, getting into that career to where you're able to earn a lot of money to tackle that debt and then pay off all that debt. Once you pay off all that debt, the third thing you need to do is build a 6-month emergency fund. This is in cash. This is liquid savings. You don't invest this money. You don't put it into commodities like gold, silver. No, this is cash that you have access to cover things like your car breaking down, a new AC unit in your house, medical bills. These are unforeseen expenses that you didn't expect would happen, but we all know life happens, and sometimes you have emergencies pop up that you need to handle. And the point of doing this before you invest, the point of doing this is so that whenever you do start investing, you don't take from your investment, you don't sell your investment to cover those expenses, or you don't go back into debt. You don't use a credit card to cover those expenses and have to go back into debt. The point is once you get out of debt, you stay out of debt. You build that emergency fund so that you don't go back into debt, or you don't touch those investments once you start. Okay? And so that's pretty much the first part. Now, after you save that emergency fund, that is where you want to begin to invest your money. Okay? In my opinion, if you want to save up money to start a business, say you want to become an owner operator, you want to start that trucking company, I would do those first few things first and then save up to do that. And that's what I would do. Or if you want to save and invest in real estate, you could do that. There's other options, but I personally chose to invest in a broadly diversified index fund. That's what I chose to invest in. Well, now it's two. Okay, I put 75% of my money into a total U.S. stock market index, and I put 25% now into an international index. When I first started investing, I put 100% of my investment dollars into the total U.S. stock market index fund, but now I began to contribute to a international index fund. And I'll kind of explain that when I go through the funds. I'll kind of explain why I'm doing that. Over the last 2 years, I've been buying that international index fund. So most of my money is in the United States stock market. It is, but I do have a percentage of my money now, and I contribute 25% of whatever I invest now into that international index fund. And so, again, I'll be getting into why that is. So why index funds for me? Well, because in order to invest in a business like trucking, or in order to invest in real estate, you do need a lot of money to begin to invest. That's number one. Whereas with index funds, you don't need a lot of money to begin to invest. You can pretty much, as long as you have enough money to buy a share of an ETF, you can start investing. Like an ETF, you can buy one share, or if you can afford one share, you can begin to invest. An index fund or a mutual fund version of the same thing, you may need like $3,000 to begin to invest in that index fund. Either way, you're pretty much owning the same portfolio. But it's a very minimum amount required to begin to invest compared to other assets like starting a business or investing in real estate, right? And so not only that, why do I not buy single stocks? Why do I not buy crypto? Why do I not invest in actively managed funds or give my money to a financial advisor for him to manage? Well, the reason I don't do that, number one, I don't pick single stocks because most retail investors, most individuals like me, not institutions, but retail investors, underperform the S&P 500, the broader market, dramatically. Actually, the statistics are about most retail investors average about a 3% rate of return annualized per year over a 10-year span of time. And once you get past 10 years, it's even lower than that. Compared to the S&P 500, since inception, the index has averaged roughly a 10 to 12% rate of return since its inception, okay? And so most people are going to underperform the market. And that leads me to also, why not use a money manager? These are professionals. These are guys with PhDs in finance. They work on Wall Street. Most of them, 90% of mutual fund and hedge fund managers underperform the S&P 500 over a 10-year span, 90%. And once you go to 15 years, it's even lower than that, over or outperform the S&P. As you go on, the longer period of time you go, most money managers, most hedge funds underperform the index over time. They do. And so the way I look at it is, yeah, I do know how to look at financial statements. I do know how to analyze a stock. I've taught myself how to do that, but I don't believe that I can outperform the index over a 10-year, 20-year, 30-year span. I don't believe I can do that. I think I can beat the index in any given year. I do believe that. But I don't believe over time that I would continuously outperform the index. And I don't believe most people can do that. You may be saying, well, what about like Warren Buffett or Peter Thiel or some of these guys are famous for a reason. Okay, they're the Kobe Bryant of investing. They're the Tom Brady of investing, the LeBron James, the Michael Jordan. That's who they are. Okay, you can't do what they do. You're also not equipped with the knowledge and the ambition to do what they've done. And so what I prefer to do, why index funds, is I prefer to maximize my income, minimize my expenses, and put as much money into the index and get that average market return over time. Okay. And by doing that, I'm going to outperform 90% of professional investors. I'm going to do that with very minimal effort. As long as I understand that I'm investing in the United States economy. When I buy an index fund, I own a piece of every industry. I own a piece of every company publicly traded in the United States. Okay, every sector, and I'm going to be going through that. And I'm betting on the future growth of the biggest, brightest, and best companies in the world. That's what I'm doing. When I buy an international index fund, I'm also doing the same thing. I'm investing globally. I'm investing in companies like China. I'm investing in Europe, Australia, even emerging markets. These are small countries that could emerge into big economic powerhouses. So that is what I'm doing by buying the world, buying index funds. I'm betting on the future growth and prosperity of the global economy. That is what I am doing. And so that's going to lead me to what index funds do you buy? I talk a lot about that. This is the one I personally buy. Most of my money is in this fund. This is the Vanguard Total U.S. Stock Market Index Fund. Now, the ETF version is VTI. You can go look that up yourself. They both hold the same, it's the same portfolio, both of those. One is the ETF version, one is the mutual fund version, okay? And so anyway, this fund I like the most, okay? I'm going to do some very generic explaining of these funds. If you want to go after this video and go research these different index funds yourself, you can go do that. Go look up everything you need to know. There's plenty of YouTube videos explaining every fund I'm about to talk about in depth. I mean, they will explain it totally. I'm going to give you a very basic explanation of what you own when you invest in these index funds, okay? So the Vanguard Total U.S. Stock Market Index, VTSAX, is the ticker symbol. You own every publicly traded company in the United States, held at market cap weights. What is market cap weights? That means the largest companies make up the larger percentage of the index, okay? So companies, the top 10 holdings, for example, make up about 20% of the index. The largest companies make up the majority of the index. This fund is very similar to the S&P 500 the 500 largest companies in the United States. I'm going to be showing you an S&P 500 fund too. It's very similar to that. Both of those funds pretty much go hand in hand. Whatever the S&P does, the total US stock market's pretty much going to do what that does. Why? Because being that the Vanguard Total US Stock Market Index is market cap weighted, the largest 500 companies, the S&P 500, makes up 80% of the United States stock market, okay? But the beautiful thing about this fund here that I love is that I get exposure to smaller and mid-sized companies. That other 20%, I get exposure to the smaller and mid-sized companies. That's what I like about it. It adds a little bit more spice to my investment, and I like that. I like owning the entire market. Now, you can't go wrong with the S&P. You cannot go wrong with that. I would pick either this or an S&P 500 fund. They're pretty much the same thing, and they're pretty much going to do about what the other one does. One is going to do what the other does. They pretty much mirror each other. Why? Again, because they're held at market cap weights. The largest companies make up the larger percentage of the index. Okay, so you want to look at things like past performance. You want to look at that to understand the past performance. And on here, it's going to show the last 10 years. If you want to, go look yourself and look at the last 20-year performance, the last 30-year performance. You can do that yourself, okay? And then you want to look at like expense ratios. Another reason why I don't use active managers or invest in active funds is because of their fees, their expenses. Look at the expense ratio on here. It is 0.04%. A lot of active funds will charge you 1.5%, 2% to manage that fund. And again, like I said, 90% of them don't even outperform the index. Why would I want to give away 2% of my investment return to a money manager to just underperform the index? Why would I want to do that? That's why I buy index funds, 100%. And so as I go down here, I can show you the 10-year return. Over the last 10 years, this fund has actually done more than 10%, much better than 10%. It is up 11.94%, and this is compounded annual growth, by the way. This is 11% every single year compounded. This is not 11% in 10 years. This is 11% compounded. Okay, and so you look at the last 5 years, 11%, the last 3 years, 13.82%, the last year to date, 20%, because we've had a massive run up over the last year. And year to date, this is since January, we're looking at an 18.19%. But you want to look at the long-term average when you're picking your investments. I would even go, after this video, go look up what's the 20-year return, what's the 25, 30-year return. That's what I would look at. Now, some funds are new, like the Total World Index I'm going to show you is a new fund. It doesn't even have the last 10 years of returns. You can go look that up, though, what the total return is of the World Index that I'm going to be showing you in this video. So yeah, you want to look at things like expense ratios. You want to look at the historical rate of return. You want to understand how the investment is allocated, okay? And so you can do that. You can come down here and you can see, here's all the different sectors: sector allocation, technology, financials, healthcare, consumer services, industrials, oil and gas, utilities. You go down, you can see the percentage of allocation in each sector of the economy. That's the entire economy, guys. And as you go down, you can look too at the top 10 holdings right here, and you can see Apple's number one, Microsoft. You see how Apple, it makes up the largest percentage of the index. 6.5% of this fund is Apple. That's what it is. Microsoft, Amazon, Nvidia, Alphabet, which is Google. They have two different share classes. You got Meta, Berkshire Hathaway, Tesla, United Healthcare, and you can go down. You can even look up what the top 100 holdings are if you want to. Go look that up after this video if you want to do so. So that's the total U.S. stock market index. This is my favorite fund. Over all of them, this is probably my favorite one. Why I like the United States over everything is because we live in the best country in the world. We are the reserve currency of the world. The US dollar is. We are the biggest economy in the world. We have the best companies in the world. And when you own companies like Apple, Microsoft, Google, Nvidia, companies like that, these are international companies. They operate all over the world. So you not only have exposure to the United States economy, you have exposure to international economies as well, because as the world grows, American corporations like this will grow. So understand, 40% of the revenues that the S&P 500 companies earn actually come from international markets. Okay, which leads me to the next fund. The next best thing, in my opinion, is just an S&P 500 fund. Okay, I'm not going to spend too much more time on this. It's pretty much the same thing. Like I said, you just don't get that exposure, that 20% exposure to the smaller companies. You don't. Okay, and so it has the same expense ratio. You can go down, and actually, large cap on this S&P 500, you can see that it's averaged over the last 10 years a 12.46 rate of return. That is a killer return, but that's because large cap has done better than small cap companies. It has, okay? And but that does not mean in the future, going into the future, that smaller companies will not begin to do well, and that total U.S. stock market won't actually slightly outperform the large cap companies. But if you own an S&P or the total U.S. stock market, you're going to do well either way if you invest in either one of these funds over time. And so I'm going to show you like the top 10 holdings, and they're pretty much exactly the same thing, just a little bit higher allocation, because this is all in the S&P top 500 companies, and it's heavily weighted in technology. You can see 32% technology, financial, healthcare, consumer, industrial. You can look at all the different sectors. You can look at the top 10 holdings, see it's a little higher for Apple. Again, that's because it's the largest company. A little higher for Microsoft. It's an S&P 500 large cap fund, right? So these larger companies make up the largest percentage of the S&P 500. So that's pretty much the American market. Now, I'm going to be showing you the international fund. Why did I only invest in the total U.S. stock market over international? Why did I do that? Why did I not start investing in international starting out? Okay, knowing what I know now about investing globally, I would have just bought the last fund I'm going to show you. Instead of combining these two, I would have just bought one fund and called it a day. That's what I would have done. But when I first started, I started reading books like The Simple Path to Wealth, and learning about, Jack Bogle and what he preaches, and owning the United States stock market, and how, you do get that exposure to international markets by just owning the United States companies. But I also do believe that there are great companies that are internationally based, companies like Nestle and all the different auto manufacturers, Toyota, Volvo, Mercedes, BMW. These are international companies. You got companies like Taiwan Semiconductors. You got a lot of different companies that are great companies that are internationally based, and they do business in the United States as well. Not only in the countries they reside in, but internationally. We live in a globalized economy, and so that being said, international has underperformed. International stocks have underperformed the U.S. stocks. They have. 100% they have, and by a significant amount. But markets go in cycles. If you look at the last 40 years, sometimes international does outperform the United States. It does. And the way I look at it is, I want to have some exposure to international companies in case it does outperform over the next 15, 20 years. Because US has crushed it over the last 20 years, but there is a good chance that international could slightly outperform the United States over the next 20 years. Never know. So why not just own the entire world and let the market figure it out, right? And so it's the same thing with international, though. This fund, the VTI SAX, the Vanguard Total International Stock Market Index Fund, this one, or VTIAX, sorry, this fund, you pretty much buy everything in the world excluding the United States stock market. You're buying every country. That's what you're buying, and I'm getting that diversity outside the United States. Over the last 2 years, I've been buying this fund. I've been putting 25% of my income or investable dollars into the total international stock market. And that's why I've been doing that. Why I want to just have global exposure. I do. I at least want to have some international in my portfolio, 100%. So look at this is sector allocation. You can see financials is the top one, industrials, consumer goods, technology, healthcare. You can look at the sector allocation. You can go down and look. Taiwan Semiconductors, Nestle, ASML Holdings, Samsung, okay, Tencent, it's a huge company, AstraZeneca, Shell, Toyota, right? You can just go down the line, and a lot of these, Sony, these are companies, Royal Bank of Canada, these are companies that we have heard of before, and they do business in the United States, like I said. And so you can go here to the overview, and you can look at the expense ratio. Now, the expense ratio is 0.11%. It is higher than the United States stock market. I don't know why that is, to be honest with you, but it's still not high. Compared to active funds, it's honestly nothing, and it's worth it to have that exposure to international. Like I said, if you don't want to invest in international stocks, you're just fine buying a total U.S. stock market. You're just fine doing that. Me personally, it's just my preference to have that international exposure. And as I go down here, you can see, look, the last 10 years, the S&P has made, what, 12% a year? This is pretty much like 5% per year. That's what it's averaged over the last 10 years. And so, yeah, you want to just look at that. But again, past performance is not indicative of future returns. It's not. And so you have to understand that there is a potential hold on a second, there is a potential for international stocks to outperform the United States over the next 10, 15 years. That is a possibility. Understand that. So that is why I buy international. Now, knowing what I know now about global investing and having exposure to international stocks, if I were to restart my investing and if I knew about it to begin with, I would have just bought the total world stock market index, VTWAX, VTWAX. I would have bought the total the total world market, held at market cap weights, and just set it and forget it and let the world figure itself out. Okay. Now, this is a pretty new fund. It does not have the last 10 years of returns, but I did look at it before I started this video. And the last 10 years of the global fund, it was roughly about 10.5% was the compounded growth over the last 10 years. So very close to the total U.S. stock market and the S&P 500. The reason why it's underperformed, again, is because international has underperformed the United States. But going into the future, again, if you own the total world market, if international outperforms U.S., you will actually slightly outperform the U.S. But if U.S. continues to outperform, you'll receive the benefit of both investments, both United States and international. So here's the last 3 years, 11%, 1 year, 19%, 60%. It's very correlated, okay? Pretty much the global market is they pretty much go hand in hand, honestly. One will outperform the other, but over time they pretty much go up or down with each other in sync because we live in a globalized economy. Now, you can go to and look at the total world index, and the expense ratio on this one's 0.1%. And hold on, you go down, you can see sector allocation, technology, financials, industrials, you can look at that. You can see that Apple, a much lower percentage of the world index versus the U.S. stock market index, much lower because you own way more companies, and a lot of them, again, are international companies, right? And you can go down and see all these different stocks that you own in this index. Again, held at market cap weights. Look at the percentages and how much of the index it makes up. And that's what you want to do. You just want to understand how diversified you are. You want to understand the historical rate of return, and you want to understand expense ratios, and you just want to understand, again, the allocation, right? Uh, the world stock market is roughly 60% US because we're the largest company in the world, largest economy in the world. Our companies are the highest value in the world. And then it's about 40% international. That is what the total world stock market index is. Okay, we have the largest market cap in terms of our companies, and so that is why U.S. makes up the majority of this fund. But anyway, long story short, as long as you're broadly diversified, as long as you're broadly diversified, you either own the total U.S. stock market or a variation like I do, 75% US, 25% international. You could go 50-50, wouldn't be a bad idea. Or you could own just a global fund, set it and forget it. Either way, as long as you're broadly diversified, you should get that historical uh, return on average over a 10, 15, 20, 30-year span. What you're betting on, again, is the future innovation, the future growth of revenues and profits of the world's biggest, brightest, and best companies. That's what you're doing when you buy an index fund, no matter which index fund it is. Okay. And so, yeah, those are the funds I like, guys. Those are the funds I like. And that leads me to this is what you want to do at the end. Once you understand the investment, once you're out of debt, you have your emergency fund, and you understand the investment. Now you can figure out, okay, what can I realistically save every year, and what is that going to equal? What is that going to equal by the time I hit retirement age, or how long is it going to take me to save for that retirement, that financial freedom goal, or that retirement goal? Well, what you want to do is you want to, in my opinion, and this is what I use, is the 4% rule, the 4% withdrawal rate. Okay, you have to figure out how much money you need invested, and to where you can withdraw 4% of that investment to live on and not cut into the principal of that investment. Okay, so what you want to do to calculate your number, your retirement goal, your financial freedom number, is you got to figure out how much money do I need to make every month. That's number one. To pay all my bills, to live the life I want to live. Then you multiply that number by 12. Everybody has a different number. You multiply that by 12, and then you divide that number by 4%. Why 4%? Why the 4% rule? Well, because the theory behind that is the market on average averages about 10% per year over a long period of time. Okay, now understand, index funds, the stock market, does not go up 10% every year guaranteed. It's over a 10, 20, 30-year span that you get that average. And I showed you that average of the last 10 years for a few of these funds. But you get that average over time. Okay, so, but the theory is, okay, you may get 10% per year on average. That's what you're going to get over the long run. Okay, and if you withdraw 4% to live on, and you're able to do that, you're able to retire on that 4% withdrawal rate, you're leaving the other 6% in there in that investment to compound and grow for you over time. That way you keep pace with inflation. You leave a little bit in there to actually grow and beat inflation. And that way you never dip into the principal of your investment, okay? And you never lose any money. Once you want to be able to retire and not lose your wealth. You want to preserve your wealth over the course of being retired and living on that portfolio. That is why you want to figure out what your target is, and with the 4% rule. It's a general rule. You could do 3%. You could even do 5%, in my opinion, and be pretty conservative on that. But anything above like 5 and 6%, you're withdrawing too much, in my opinion. But anything 5 and under, you're good. Me personally, because I want to create a lot of wealth beyond just myself and beyond my family, I use the 3% rule. 3%. So, and that 1% difference actually does make a huge difference, 100%. So, I'm actually being unloaded right now, so I'm going to try to wrap this video up by showing you some numbers And again, if you have any questions down in the comment section, leave your question. And again, I'll make a video if it's video worthy. If you ask me a really good question. But so what I would do is I'm going to give you some examples of the power of saving and investing. It is unbelievable. You can max out. You and your wife can both contribute $6,000 into a Roth IRA every single month or every single year. And all of that money that grows in that Roth IRA is tax-free when you withdraw it at retirement. So let's say you're 25, okay? Now, if you're an individual, it's only $6,000 a year. You can put into that Roth IRA and it grows tax-free. If you're married, filing jointly, and consult with your CPA about this. But if you're married, filing jointly, you can invest $1,000 or $12,000 a year combined. Okay, so I'll do the individual. Let's say you're going to work from age 25 to 55. You want an early retirement, right? And this is just the power of investing. Guys, you can put way more money than this. Go play with the investment calculator after this video. It's amazing. Some of you truck drivers out there are able to save like $3 grand, $4 grand a month, $5 grand a month, $6 grand. If you're an owner operator, you may be able to save much more than that. It's amazing, the power of saving and investing over time. So let's say you're starting with nothing and you're able to contribute $500 a month. That's a Roth IRA, tax-free. And you're able to get that historical rate of return. This is for 30 years. All you're doing is saving $500 a month. $500 a month. Anybody can save $500 a month that's watching this video. I don't care if you work as a warehouse worker. You can do this. $500 a month. Anybody can do this. Put it into a Roth IRA. And look, after 30 years, you're worth $1.1 million after 30 years. Okay? Now, let's say you want to work until you're 60 and you can start taking Social Security. 1.8 million. Okay, and I'm going to do the math on that. Do the math. Let's see here. I'm going to do 4% of that. 8 million times 4%. That's a $72,000 a year income that you could withdraw using the 4% rule on that. That is tax-free, by the way. Okay, that is tax-free in a Roth IRA, right? Can you retire on that? I think anybody can. If they're out of debt, have an emergency fund, have low expenses, I could retire on that. Easily could retire on that. $72,000 a year, passive income. Yeah, I could do that. And I think anybody can. Let's say you and your wife. Okay, you and your wife are contributing for 30 years, okay? $1,000 a month. Both of you are maxing out a Roth IRA. 2.2 million, right? 2.2 million. 2.2 million times 4%. That's an $88,000 a year income. And this is just an IRA, guys. This is not saying like what if you start a business? You come into trucking, you're making 80, 90 grand a year. You're able to put away way more money than this, in my opinion. You could probably put away $3,000 a month for a 30-year career. Easily. Okay? Let's say you put $2,000 away. 4.5 million, right? For 30 years. And this is retiring early. This is not including if you work until you're 60 or 65. Some people don't want to quit working. They want something to do, right? Let's say you're able to do $2,500 a month. 5.6 million. You know, you just play with the math, guys, and figure out what you could realistically save, all right? Now, if you want to be aggressive, let's say in 10 years, how much could you do in 10 years, okay? Say you want to save up and buy a truck cash. You want to be an owner-operator. Who's to say you can't begin to invest some money and be able to start your business in cash over probably you can do it in like 5 years easily. Okay, I'm able to do it and I haven't even hit 5 years. And that's just by doing exactly what I'm talking about in this video. Say you're able to save $3 grand a month for 10 years. $614,000. Is that enough money to go buy a truck and trailer cash and keep some money in there to continue to grow for you? 100%. What about just 5 years? $232,000. Saving $3 grand a month. You could probably save $4 grand a month, to be honest with you. Especially some of you guys that are like living on the road. You really don't need much money. You just got to pay for your phone bill and some insurances and maybe some food every week. Dude, you could put away easily $1,000 a week. You do that after just 10 years, you'll have $819,000. After 5 years, $309,000. Investing that much money, multiple six-figure net worth. You asked me how I did it. This is how I did it. I've been asked, how did you do that? This is how I did it. I got out of debt. I minimized my expenses. I have an emergency fund, and I'm able to invest large amounts of money like this every single month. My wife and I both do it, but if it was just me, I would still be able to invest that large of a percentage. Why? Because I have no bills. And my income has increased every single year since I got into trucking. So I just wanted to show you the power of investing, the power of saving over time. The most important thing to end this video, the most important thing when it comes to saving and investing, the most important thing is savings rate, like I'm showing you. Look at the difference between putting $2 grand away, $3 grand away, $4 grand away. Savings rate is the most important thing. The amount of money you're putting in is almost more important than the rate of return you're getting. The rate of return matters too. You do want to grow that money, but the amount you're putting in is what matters the most. It does. You do this for just 5 years. 5 years. Okay? Whether you save up 200 grand, $250,000, 300, some of you are going to kill it and save up 400,000. Okay? Whatever it is, either way, it's better than being broke. And either way, after about 4 years of doing this, 5 years of doing this, you are going to have so many options. You are going to have enough money to invest in real estate, invest in your own business if you want to do that. And by doing that, you would increase your overall income and you can go right back to buying index funds. And to end with this, understand though, you at least need to, in my opinion, give yourself a 5-year time horizon to invest in stocks. Because the stock market's volatile. It is. It goes up, it goes down. There can be some years where the market goes down 25, 30% in a year. But if you're willing to take that risk over a 5-year span, most times the market does make money over 5 years. Most times it does. Historically speaking, it almost 100% of the time over a 5-year span it does. But anything shorter than that, you may just want to save the money, keep it in cash, or buy short-term treasury bonds or something like that. But anything 5 years plus, why not take some risk? As you're saving, you could be making money with that money as you're saving. That's what I've done. I plan to use some of my money to invest in other things, 100%, outside of the stock market. But the stock market has been a wonderful tool to grow my wealth, grow my savings over the last 4.5 years, and I'm going to continue to do that going on into the future. So I really appreciate each and every one of you guys for watching this channel. I really appreciate it, guys. You are why I do this channel. You are why I take the time to make videos like this. I really appreciate each and every one of you. God bless. Thank you for watching, and stay tuned for the next video. Peace out.